Hello traders, welcome to this series of educational videos that FXCM has for you. My name is David Londoño. I'm a trader and a market analyst, and in today's video I would like to talk to you about the trading in the bond market and its relation with the interest rates. The bond market is closely related to the interest rates and plays a fundamental role in the global economy. So I have a kind of walkthrough of key information about this relationship. Let's start with the bond investments. Investors purchase bonds issued by governments, companies, other entities. So these bonds represent debts that must be repaid with interest over a specific period. So there we have second part, the interest rates and bonds prices. So there is an inverse relationship between interest rates and bond prices. Remember, it's inverse relationship. We also have videos on our YouTube channel about the correlations if you want to check those before following this information. Now, when the interest rate rises, the price of existing bonds tends to fall, and vice versa. So this is because investors demand higher yields on newly issued bonds, which reduces the value of existing bonds, right? Now, bond duration. Duration is an important concept, as we were discussing before, in the bond market. It measures bonds' sensitivity to changes in interest rates. So bonds with longer durations are more sensitive to rate fluctuation. Investments and monetary policy decisions, such as changes in interest rates by central banks, significantly affect the bond market. Higher interest rates typically attract investors, potentially increasing demand for bonds. Now, the interest rate risk. Bond investors face interest rate risk if rates increases and they hold bonds with shorter durations. They may have the opportunity to reinvest at higher rates. We also have a whole video about this subject, the portfolio diversification, but here with bonds are commonly used an investment portfolio for diversified risk. They can offer stability during stock market volatility. That's also something to keep in mind. Finally, the secondary market, it refers to bonds are traded in the secondary market, right? So allowing investors to buy and sell bonds before their maturity. Secondary market dynamics also influence both bond prices, to keep it in mind, and of course the economic influence. Now, we know that the bonds market and interest rates influence business investments like mortgages, rates, and consuming spending. So all of these impact the economic as a whole. So all of these we have to keep in mind before trading with the bonds. Also, as I always do, I recommend you our articles in our FXCM platform. Here we have inside articles about bonds themselves. I recommend you to go to this one over here. Second is the government bonds, the most the risky-free bonds, for saying so. And I also want to recommend you to know about the interest rates here in our articles. We'll go with this one, interest rates, the basic information we need about all of this. You can find it here in our platform. So if you like this video, don't forget to share and subscribe, share with your fellow traders. But for now, I wish you a profitable week, a good luck, and a good trading session.